Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 2. This is section F. This is an application topic. Prepare journal entries to record the identifiable net assets acquired in a business combination that results in the recognition of goodwill or a bargain purchase gain. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the full versions of these videos. In today's video, we're only going over 5 questions, but again, the Superfast CPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. So if you like this, make sure to check out becoming a Superfast CPA Pro member after you check out the webinar. So with all that, let's dive straight into the questions for this video. All right, here we are at question 1, and one thing I always like to point out at the beginning, if it's a possibility, is you want to read the last sentence of a question first. This is a good test day strategy because it allows you to kind of get the context for what the question is about right at the very beginning so that you know what you're looking for throughout the rest of the question. So let's do that here. What is the total acquisition price Cordell should record for this transaction? Let's go to the top. On June 1st, year 1, Cordell Inc. announced its plan to acquire all outstanding shares of Mintar Co. in a stock-for-stock business combination. Under the agreement, Cordell will issue $500,000 of its own common shares in exchange for all of Mintar's shares. The acquisition was finalized on September 30th, year 1. Cordell's share price was $32 on June 1st and $36 on September 30th. So again, what is the total acquisition price that they should record for this transaction? So this is kind of just an intro question to kind of tell us one step of the process that we're going to need to know for the future questions. So if you know how to do this, if you know what numbers to use, that's fantastic. Give this a try. If not, that's okay. We're going to look at the answer together right now. All right, here we are at the answer B, $18 million. That is the amount that they're going to record as the acquisition price for this transaction. So let's go through this. This is fairly simple. In a business combination, the acquisition price is based on the fair value of the consideration at the acquisition date, not the announcement date. So the date that you need to pay attention to is the day that it was actually performed, the actual acquisition happened. So in this case, they have 500,000 shares, and on September 30th, when the acquisition actually happens, it's $36. So 500,000 multiplied by $36 is $18 million. So that's the acquisition price. The $32 share price on the announcement date is irrelevant for the journal entry purposes. It only matters what the shares are worth on the date control is obtained. So again, this is kind of an intro question. This is one of the first steps that you might need to do if you see a question kind of around these lines. So now let's go to the next question to build on this. Okay, here we are at question 2. Again, reading the last sentence first. What amount of goodwill should Hemsworth recognize in this acquisition? Let's go up to the top. On January 10th, year 4, Hemsworth Co. announced its intention to acquire all outstanding shares of Porter Inc. The acquisition was finalized on March 31st, year 4. Under the agreement, Hemsworth issued 600,000 common shares in exchange for all of Porter's equity. Hemsworth's share prices were as follows: $45 on January 10th, which was the announcement date, $48 on March 1st, which was the board approval date, and $50 on March 31st, which was the acquisition date. At the acquisition date, Porter's balance sheet reported total assets $20 million, total liabilities $7 million. The following fair value adjustments were identified. Equipment had a fair value of $3 million, but was recorded at a book value of $2,400,000. Inventory had a fair value of $1,500,000, but was recorded at $1,200,000, and an unrecorded brand name was valued at $2 million. So again, what is the amount of goodwill that's going to be recognized in this acquisition? Now, there is a lot of information here, a lot going on. If you have no idea where to go or how to start this, that's okay. We're going to learn how to do it. If you want to give it a try, pause the video and come back when you're ready. But again, if you don't know how to do this, we're going to look at the explanation right now to start learning. Okay, here we are. The answer is C. $14,100,000 is the amount of goodwill that they're going to recognize. So let's go through this step by step. First off, we have to calculate the acquisition price, which we learned how to do in question 1. So there were 600,000 shares. $50 was the share price on the acquisition date of March 31st, which that's the date that matters. So $30 million was the acquisition price. Now we have to figure out the book value of the net assets. So that was $20 million of assets and $7 million of liabilities, or $13 million of book value for the assets. And we were told that the book value matches the fair value in all respects except for a couple things. So the equipment, which was valued at $2,400,000 in the books, should be valued at $3 million under fair value. So there's a $600,000 fair value adjustment we're going to have to do there. And then the inventory was also $1,200,000 in the books, but it was supposed to be $1,500,000 at fair value. So that's a $300,000 adjustment And again, we're adjusting these both up to their fair values to make it so that the net assets are what they're supposed to be as far as fair value when it comes to this acquisition. And then the brand name was an intangible asset that hadn't been recorded, and so they're going to record it now. So the fair value for that was $2 million. So they're adding all of these things up. These are the total fair value adjustments. So $600,000 plus $300,000 plus $2 million, that's $2,900,000. And this is probably one of the more complicated pieces of this, so make sure you kind of understand what's happening here. Again, we are adjusting the things that were not the same fair value as book value. We're adjusting the book value up to the fair value. And then the brand name wasn't even on the books, so they're having the fair value for that. So again, we do these fair value adjustments. We add them to the fair value of the net assets. So $13 million plus $2,900,000, that's $15,900,000. So that is the fair value of the company that is being purchased. But they spent $30 million in this acquisition. So there's $14,100,000 that was not directly related to the fair value of the net assets, which means that was the $14,100,000 of goodwill. That is the extra amount that they were willing to pay for some reason to be able to purchase this company that's only worth $15,900,000 as fair value, but they were willing to pay $30 million to acquire the company. So that's what the goodwill is that difference where it's not a net asset that we can see as fair value, but it was still extra money that they paid because they wanted to acquire the company. So that's how you figure out the goodwill in this kind of a situation. Now let's go to the next question. Okay, here we are at question 3. What amount should Renthor record as goodwill in the journal entry to recognize the business combination? Let's go up to the top. On December 31st, year 5, Renthor Corp acquired all of the net assets of Calder Inc. in a business combination. Renthor paid $5,800,000 in cash to complete the acquisition. At the acquisition date, Calder's balance sheet reported total assets $5 million, total liabilities $2 million. The following fair value adjustments were identified. Equipment was undervalued by $400,000, inventory was undervalued by $300,000, and there was an unrecorded brand name that was valued at $600,000. So it's kind of similar to the previous question, but some different things happening here. So again, what amount of goodwill are they going to record in the journal entry when they recognize the business combination? So what amount of goodwill are they going to put in the journal entry? So we kind of learned how to do this in the previous question. I think you could try this. Pause the video, give this a try, and when you're ready, come back. We'll look at the answer and look at the journal entry as well. Okay, here we are. The answer is C, $1,500,000. So that's the amount of goodwill that's going to be in the journal entry. So let's walk through this. First off, just like we did before, we have to calculate the fair value of the net assets. So $5 million of assets plus $2 million of liabilities, $3 million. And then we have the fair value adjustments. The equipment was undervalued compared to fair value by $400,000. Same with the inventory, and the brand name hadn't been recorded. So all those things are fair value adjustments of $1,300,000. So the adjusted fair value of the net assets is $4,300,000 because again, it's the $3 million plus the $1,300,000. So now we can compare that to the purchase price. So the purchase price was $5,800,000. And so the goodwill is going to be $1,500,000 because again, it's the purchase price of $5,800,000 less the actual fair value. So they were obviously willing to pay $1,500,000 extra for this business. They thought that that was the amount of goodwill that it was worth. So now let's look at the journal entry for this. So they debit equipment for $400,000 to bring it up to what it should be. They debit inventory for $300,000, same to bring it up to what it should be. They debit the brand name for $600,000 to put it on the books. They debit other identifiable assets at $5 million, and they debit goodwill at $1,500,000. And the goodwill is again kind of that almost like that plug. It's that difference where they paid $5,800,000 in cash, which was this credit down here, but they actually only had $4,300,000 of fair value. So there's that $1,500,000 of goodwill, and that's going to be on their books as an asset because goodwill is an asset. And then they credit liabilities assumed $2 million. So again, these are the journal entries that they're going to make when they acquire this company. You know, the identifiable assets is the $5 million, but then they're also getting the fair value to be correct. So that's kind of what the journal entry would look like. Basically, this question and the past question are at least very similar. Now let's go to the next question. Okay, here we are at question 4. What amount of goodwill should Palver recognize as a result of this acquisition? Let's go up to the top. On July 1st, year 6, Palver Co. acquired all of the net assets of Brecker Inc. in a business combination. Palver paid $7 million in cash to complete the acquisition. At the acquisition date, Brecker's balance sheet showed the following. Cash, book value of $500,000, fair value $500,000. That makes sense. Cash pretty much, if not always, has the same book value and fair value because, you know, it's cash. Accounts receivable book value $1,100,000, fair value $1,200,000. Inventory book value $2 million, fair value $2,100,000. Equipment book value $4,200,000, fair value $4,800,000. Accounts payable book and fair value $1,100,000. Long-term debt book and fair value $1,500,000. So again, what amount of goodwill are they going to recognize as a result of the acquisition? Take what you've learned in question 2 and 3, think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer A, $1 million. So let's walk through this. Again, it might have seemed like there was a lot there, but let's go through this. Only fair values are used when calculating goodwill in a business combination. So even though there was all those book values, what do we care about? We care about the fair value, and we actually have the fair value for all of the assets and liabilities and everything. So that's what we pay attention to. The book values are not relevant if you have the fair value amounts. So the fair values were cash, $500,000, accounts receivable, $1,200,000, inventory, $2,100,000, equipment, $4,800,000. So that means that the total fair value of the assets is $8,600,000. And then the fair value of the liabilities was the accounts payable and the long-term debt, and those add up to $2,600,000. So again, because we already have the fair values, we don't have to do any adjustments. We don't have to think about that. There might be adjustments in the journal entries, but that's not what we're focused on here. We're focused on just figuring out what the goodwill is in this question. So fair value of the net assets is $8,600,000 less $2,600,000, $6 million. They paid $7 million. So the goodwill is therefore $1 million. It's that $1 million difference that is considered the goodwill. All right, now let's go to the next question. Okay, here we are at question 5. What amount should Levon recognize as the difference between the consideration transferred and the fair value of net assets acquired, and how should it be classified? Let's go up to the top. On October 1st, year 6, Levon Co. acquired all of the net assets of Rylan Inc. in a business combination for $3,800,000 in cash. At the acquisition date, the fair values of Rylan's assets and liabilities were as follows. Cash, $300,000. Accounts receivable, $1,100,000. Inventory, $2,100,000. Equipment, $3,400,000. Accounts payable, $900,000. And notes payable, $1,500,000. So fairly similar to the previous question, but again, it's in a different layout, some different numbers. And really the thing that we want to figure out here is what is the difference here? And is it going to be classified as we can see down here, goodwill or a bargain purchase gain? So think about this. Think about what we've learned so far. Try this out. And when you're ready, come back. We'll look at the answer together. Okay, here we are. The answer is B, $700,000 bargain purchase gain. So this is a little bit different than what we've talked about so far in the video. This is kind of the other side to goodwill. So let's walk through this. Same steps pretty much, but it ends up with something different. So calculate the fair value of the total assets acquired. Again, we were given the fair value, so we just take the cash, the accounts receivable, the inventory, the equipment, add it all up together, and that's $6,900,000 of assets. That's the fair value, remember. And then we take the fair value of the liabilities, and that's the accounts payable and the notes payable, $2,400,000. So we net those to get the net assets at fair value, and that's $4,500,000. So now we can compare that to the purchase price. Now in this case, the net assets is worth more than the purchase price. So they paid less than what the fair value of the net assets is. So they actually have $700,000 extra that they got, even though they only paid $3,800,000. So again, it's kind of the other side to goodwill. With goodwill, you're paying more than the fair value of the company because there's something about the company that you think makes it worth it. But a bargain purchase gain would be you pay less than the fair value of the company, but still get, the full fair value of the company. And maybe it's because there's some kind of reason that they're trying to get rid of the company, or you just got a good deal with the acquisition, whatever the case is. Again, because the fair value of net assets exceeds the purchase price in this case, the difference is recognized as a bargain purchase gain under US GAAP, not as goodwill. It's kind of the other side of it, like I said. So we learned a lot in these 5 questions. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about calculating goodwill or whatever the case is in these acquisitions. Whatever the case is, these are the things that you notice in the questions. These are the pillar topics that you pull out and write in your own words so that you know what is most important for exam day based on the questions that you practiced with. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Again, the idea behind this is these are basically the most important key points that you would have pulled out from the questions that we went over. You might have written them differently, or maybe you would have even come up with some different pillar topics than me, but this is the basic idea right here. So let's go through it. First off, goodwill is calculated as the excess of the purchase price over the fair value of net assets acquired. Pretty easy. Now let's go to the next one. Only fair values are used when determining goodwill or a bargain purchase gain, even if book values are also provided. So you need to make sure that you pay attention to the fair value or how to calculate the fair value. Now let's go to the next one. A bargain purchase gain occurs when the fair value of net assets acquired exceeds the consideration transferred. Okay, so again, that's kind of the other side of the goodwill. In a business combination, all identifiable assets and liabilities are recorded at their fair values in the journal entry, and the acquisition date share price is used to calculate the consideration transferred when stock is issued. Again, these are the key ideas, the key points that you could have pulled out from the questions that we did. That is the idea behind pillar topics, so that you are really focusing in on the most important things you need to know for the exam. And with that, those again are the pillar topics for this YouTube version of the video. And that is the end of this video. Remember, SuperfastCPA Pro members are going to get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other videos or our other products, make sure you check out becoming a SuperFast CPA Pro member. Now, the easiest way to learn about and become a SuperFast CPA Pro member is actually by going to superfastcpa.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And again, that will give you a better path to learning about and becoming a SuperFast CPA Pro member. So check out the webinar, check out becoming a pro member. Now, if you found this video helpful, make sure to like it and leave a comment. I hope it was helpful, and I will see you in the next one.